Friends, today we will learn about Accounting Standard 22. This deals with accounting for taxes on income. So we will have income tax, and in income tax there are some components like current tax, deferred tax. We will learn all these interesting words today. So it's going to be a very interesting standard that we are starting today. This standard is based on a few words which you would have already heard of. Prudence, matching concept, accrual. Did we hear of these words in the past? Definitely, right? At CPT level itself, we would have heard of these words. So you will realize that in accounting standards, all these big standards are all based on simple words, simple concepts like matching concept, matching between the incomes and expenses in a specific period, right? Then you talk about accrual, where you account for something when something accrues to you, not when you actually receive or pay. So these kind of concepts, what we would have learned at CPT level, we will use them and learn how the standard on accounting for taxes on income works. Now, what is matching? Incomes and expenses should be matched in a specific period, meaning if you are recording income of a specific period, expenses for that period also should be recorded in the same period, right? So you have to have in a P&L account incomes and expenses of a period captured at once, right? So that is what you mean by matching concept, right? Let us take a small example on income taxes. Imagine there is a company which is subject to taxation, meaning that company has to pay income tax. Okay, fine. Now, there are two columns. First column is for Companies Act based calculation, or we can call it as accounting standards based calculation. So this is for accounting purpose, right? This second column is for income tax purpose, right? So we have one column for accounting purpose and another column for income tax purpose. Now, sales of this company, say 10 crores. Then expenses, direct costs of this company, say 6 crores. So 10 minus 6, 4 crores. Then depreciation as per Companies Act for this company, say 2 crores. So 10 minus 6 minus 2. So what is the profit right now? 2 crores is the profit. Okay, great. 2 crores is what we have as profit here. Now on this profit, say if you apply tax rate of 25%, if tax rate be 25%, apply 25% on that. So 2 crores into 25%. So what will the taxation be? Tax will be about 50 lakhs, right? So this is the story what you see as per accounting. Now listen carefully, friends. There are a few terminologies what we have to learn from this. There is something called as profit of 2 crores. That profit of 2 crores is based on accounting calculations. That profit is called as accounting profit. Okay, so we call it as accounting income in our accounting standard. So it is an accounting calculation based profit. We call it as accounting income as per this accounting standard. Now, based on that, you made a tax calculation, right? The tax calculation 50 lakhs what you got, we will call that as tax expense. We will call that as tax expense. So 2 crores we called as accounting income and 50 lakhs is the tax expense, right? Fantastic. Now, how does the income tax calculation work? Profit before tax what we had here is 2 crores. As we all know, in income tax, this 2 crores is the logical beginning point. So this 2 crores, profit before tax, 2 crores, that's the logical beginning point for income tax calculation. So imagine, so this is 2 crores, profit before tax. Then what do? Depreciation, whatever we considered as per accounting purposes, this we add back and we will subtract depreciation as per income tax norms, because income tax depreciation rates, income tax depreciation calculations are all different compared to the calculations what we make for accounting purpose. So 2 crores is the profit before tax, we add back the depreciation which we applied for accounting. So 2 crores plus 2 crores, we added back 2 crores minus depreciation as per tax purpose. Say it is 3 crores. Okay. So if it is 3 crores, then what will happen? 2 plus 2 minus 3. What will the profit for tax purpose be? 1 crore. This profit is called as taxable income. On this taxable income, we will apply tax rate. Now, if we apply 1 crore into 25%, 25 lakhs, that 25 lakhs will be called as current tax. Alright? Here we learned 4 important aspects. What are those? Accounting income. What is accounting income? In our calculation we had 2 crores, right? That 2 crores is the accounting income. Then we had something called as tax expense, which is 50 lakhs in our example, right? So that is called as tax expense. Then we learned something called as taxable income. This is income calculated as per income tax norms. And fourth one is current tax. Current tax is how much in this example? 1 crore into 25%, 25 lakhs is the current tax. So let's first look at those definitions what we spoke about just now. Accounting income. It is the net profit or loss for a period as reported in the statement of P&L before deducting income tax expense. So generally we call this as profit before tax. We are calling it profit before tax. Sometimes it might even be loss before tax. Next, tax expense. Tax expense as per books of account is the aggregate of current tax plus deferred tax charged or credited to the statement of profit and loss for the period. Well, this sounds like a big definition. To keep it in simple terms, tax expense is equal to current tax plus deferred tax. What is deferred tax? We will discuss that in some time from now. Taxable income. The amount of income for a period determined in accordance with tax laws based upon which income tax payable is determined. So basically the tax based calculation, so tax act based calculation, we call it IT Act, right? So as per Income Tax Act, whatever we calculate as income, we call that as taxable income. Next, current tax. It is the amount of income tax determined to be payable in respect of taxable income for a period as per income tax laws, or tax computed on taxable income which is payable in the period. We spoke about taxable income. On taxable income, if you apply tax rate, we arrive at something called as current tax.